So today we are hosting Giles Coghlan. He is a chief currency analyst in HYCM. He will talk about how to make FX trading decisions on central bank policy. We used to host him before, and we have a very insightful and interesting sessions, I think 3-4 times before, right? And we get very good feedback from the students. And I'm sure this will be very interesting as well. Yes, Giles.
Thank you very much. Well, thank you very much for inviting me here today. Can everybody see my screen and hear my voice okay? Is that all coming through clearly? Thank you very much. Thank you for the nods. That's very helpful. I'm also going to make sure that I can see what I'll do. I'm just checking I can see the chat box. And what I will do is, if you have any questions when we're going through, just put them in the chat box. I'm hoping that I'll be able to see them all. If you could just experiment that that's working okay, that would be great. I haven't used Zoom for a while. Oh, thank you, Simon. That's great. Excellent. Hello, Omar, Mohammed. Great. So the way I'm going to run this is I'm going to present the webinar about making FX trading decisions on central bank policy. I also want this to be interactive and helpful for you. So if there's anything you want to know that I am not covering, just put it up in the chat box. My opinion is that the only stupid question is the question that you don't ask. So please don't have a question that you really wanted to ask and didn't. Make sure you ask it, and I'll check at the end that I've made sure I've got everyone's question. The presentation is going to be structured this way. I'm going to introduce myself, where I'm from, HYCM, which is based in Dubai. And then I'm going to give a gentle introduction to making trading decisions on central bank policy with some big picture narratives. I always find simple big pictures help you understand how to contextualize the detail. Then we're going to get into some detail, as well as some current examples we've just seen with central banks. And then I'm going to look at the next central bank meeting that's coming up from the Reserve Bank of New Zealand on November the 23rd. And I'm going to show you exactly how I'm going to approach that meeting from a trading perspective. So I hope you're going to get theory, a bit of what's happening in practice, and then looking at how we apply the theory in the future. So it should be a really helpful webinar for you to attend. If you have any questions, please do ask them as we go through. So I'm going to very briefly introduce myself. I am the Chief Market Analyst with HYCM. We've got regulations throughout the world. Very important whenever you're trading with a broker that you have a regulated broker, as that means your funds are much safer when they're regulated. We've got offices around the world: London, Dubai, Kuwait, Hong Kong, Limassol, and we've won a number of awards in the UAE region, and we offer a whole range of different trading facilities. Now, my role as a chief market analyst, I've been with HYCM for about 5 years, and I've got around 13 years experience, and my specialist area is really trading FX. So I'm very pleased to be sharing with you an area of my specialism. And this is what I do day to day, looking at FX trading moves for a group of around sort of 500 people. I continually outline what to expect on a day-to-day basis, as well as updating HYCM's blog and my own trading. So I've introduced myself. This is making FX trading decisions on central bank policy. So first of all, just to make it crystal clear so that we don't make any mistakes, monetary policy is very simply what the central bank or the government does, but we would call that fiscal policy, takes to influence how much money is in the economy, how much it costs to borrow, what the level of interest rates are. And the central bank policy moves a currency like an engine drives a car. It's a simple analogy, but it's helpful. If you took monetary policy away from a country, the currency would not have the same drives. So the central bank is trying to direct a currency in accordance with its aims and desires. And remember, what a central bank wants is stability for its exporters and its import markets. The last thing a central bank wants to see is a wildly fluctuating currency. Now that helps currency traders because a central bank is trying to tell financial markets what its intentions are. And that's where we can make FX trading decisions as central banks communicate their intentions to the market. So what we're looking at, and the best way to understand this from a trading don't worry, that happens to me all the time. I have this squawk that constantly turns up and interrupts what I'm doing. So don't worry about that. That happens to me all the time. Now, the best way of understanding what happens to FX markets is to think of it like this. This is what we're looking at when we're trading. This is the big picture I spoke about. If you look at those two arms, you'll see one of those arms is comparatively strong, isn't it? The other arm is relatively weak. So if I said to you, which arm is going to win that arm wrestle, most of us would say, look, it's the bigger, stronger arm that's going to be overpowering the weak arm. Now, when you're trading currencies, they're traded as pairs. So you would trade the pound against the dollar against the Swiss franc, the pound against the yen. So when we're trading currencies, we're trading one currency against another. And what we're looking for is we're looking to back the strongest currency against the weakest currency. So that's the philosophy behind the decision. And the simplest way that currencies move is as central banks increase and cut interest rates. As interest rates rise, that attracts money into a domestic market. So when the Bank of England increase interest rates, that will attract pounds into the UK as investors want to benefit from those higher interest rates. So when the interest rate rises in a normal functioning market, that country's currency rises too. When a central bank cuts its interest rate, it means that the interest rates are less advantageous, and so there's outflows of currency from that economy. So rising interest rates, a rising currency, falling interest rates, a falling currency. So here you see, really what we're trying to do when we're trading FX is we're trying to back a strong currency against a weak one. So we want to find a central bank that's increasing interest rates against a central bank that's maybe decreasing interest rates. So let me give you the best example. Let's say there were two central banks meeting on the same day. And let's say one central bank says, we're going to raise our interest rates by 50 basis points in a surprise move. Well, that country's currency would gain. And imagine on the same day, a different central bank said, well, we're going to cut our interest rates by 50 basis points in a surprise move. Then you'd see, look, one currency is gaining and the other currency is falling. Now, this is the very simple narrative that I wanted to share with you. Once you understand this narrative, you understand how to put all the micro narrative detail into place. Because a central bank is either moving towards raising interest rates or it's moving away from raising interest rates. And that's what we're looking at. That's what I'm always thinking about. Does that economic data point mean a central bank is more likely to raise interest rates or less likely? If it's more likely, you expect the currency to appreciate. If it's less likely, you expect the currency to depreciate. That is the very big overview of what we're doing when we're trading currencies. So we listen to monetary policy to understand which direction the central bank is moving in. Now that is very foundational, what I've shared with you. Could you just let me know on the chat that you've understood that if that's too simple, I apologize. It will get in more depth as we carry on, but has everyone got that fundamental grasp? Because that is the foundation of what I'm doing day to day. So if that, yeah, thank you, Simon. Loaded, yes, good. Yeah, yes, thank you very much. Yes, it is a clear concept. It's also a very helpful concept, because once you understand that concept, you can then start putting in the detail. So let's give a very simple example. So last week we had the Bank of England meet, and the Bank of England, if you look at the highlighted text, this is from their interest rate statement, and I'm just going to highlight that text. Look what they said as they reached their conclusion. Starting from the majority of the committee judges that should the economy evolve broadly in line with the latest monetary policy report projections, further increases in bank rate may be required for a sustainable return of inflation to target, albeit to a peak lower than priced into financial markets. Now that's crucial, because what the Bank of England is then saying to the market, it's saying, you think the pound is expecting higher interest rates than we're expecting. So the pound is overvalued. That's what the Bank of England is essentially saying to the market. We're expecting the pound to fall. And then this was out of the decision, and I was covering this decision live as an economic data point. I trade economic data points live for a group of about 500 traders. And you can see here the pound, this is on the same day, the Wednesday, November the 2nd, last week, the pound sold off rapidly as the Bank of England projected a lower rate expectation ahead. So remember that concept, strong, weak. The central bank is saying, we are expecting not to hike interest rates as much as the market was expecting. The market prices that in short-term interest rate markets. It's constantly data that's updated, and traders constantly make decisions on that data. So the Bank of England is saying, you've got it wrong. We're not expecting to hike interest rates as much. Now, there's many things I could say on this, and there are some more nuanced points, but the fundamental concept to grasp is that the Bank of England is saying we're on a different rate trajectory than the market's been pricing in, hence the pound falls lower. So that's the introduction. Let's start going into a little bit of detail now. When a central bank is deciding its path of monetary policy, there's 4 core indicators it's really looking at. It's looking at production, employment, inflation, and growth. And it's trying to ascertain where all these different factors are at and how the overall health of the economy is, and what the bank needs to do to maintain inflation to a target of around 2%. Most central banks have a target of there or thereabouts about 2% inflation. Now, we all know at the moment, don't we, that inflation is incredibly important to central banks, and central banks around the world are looking to bring inflation down. Now, the only real tool that a central bank has to successfully bring down inflation is to increase interest rates. That's been tried and tested, and it works. So central banks tend to hike interest rates to bring inflation down. That's why interest rates are rising around the world. The Federal Reserve hiking interest rates, and Jerome Powell just last week as well repeated to markets that they're going to keep hiking interest rates. And remember, he said that interest rates may be higher than we previously expected. So we'll come to that as a little case study as well later in the presentation. But at the moment, central banks are really focused on inflation. And there's a couple of key things I need to say to you here. One, although there's 4 indicators, production, employment, growth, and inflation, when you're making trading decisions, those factors are not always equally important. So you don't need me to tell you that a central bank would be very sensitive to inflation. So let me give you a silly example. let's say the inflation data out of the US on Thursday this week came in, it came in at, say, 2%. I think it's about 6.7%, 6.5% expected. Imagine it was 2%. What would that tell you? Well, that would tell you that the Federal Reserve will be so happy, inflation is falling, they won't need to hike interest rates so much. What would happen to the dollar? The dollar would plunge, gold and silver would surge, 10-year yields would plummet, and equity markets would rip higher on just that one data point. Why? Because markets are very sensitive to inflation data right now. So that's a very important point to grasp. All of these data points have different levels of importance at different times. Now you might say, Giles, well, that's impossible. How can I know what the central bank is focusing on? It's very easy, because the central bank tells you. When you read the monetary policy report, they will tell you what they're concerned about, what they're worried about, what they're focused on. And even with the current example, you don't need to be studying economics to realize that inflation is a key focus for central banks. So it's a point that you need to be aware of, but it's not a complicated point, particularly when the central bank will communicate that to the market via the statements of monetary policy that it releases at the time of its interest rate decision. So the central bank then has 4 real tools to ensure that price remains stable. Number 1, interest rates. That is crucial. And really, that's the main player on the field. Are interest rates rising or falling? Secondly, central banks can use price control. Now, this tends to be unsuccessful, but central banks still will try to use it. We'll look at some examples. The third tool they'll use is language. When you're reading monetary policy statements, the addition of a word or the omission of a word can be extremely important. Sometimes stocks can rally hundreds of points just because a central bank statement missed out one word. So it's quite funny, considering that monetary policy should mainly deal with finance, there's an awful amount of language and words that are used as central banks communicate, and sometimes just the addition or omission of one word will make a big difference. And then there's quantitative easing and asset purchases, which in 99% of the time will weaken a currency's currency. And for those of you who are astute, will say, but hang about, what about the Bank of England's QE 2 weeks ago or 3 weeks ago, which helped the pound higher? I'll explain what's going on there. So they're the main 4 tools. Let's take a quick look at them. Interest rates, it's the number 1 tool. It's used to control price inflation. If inflation is getting too high, the central bank hikes interest rates. That cools demand, that cools inflation, prices fall. And you can see the impact on FX markets when a central bank surprises markets. Now, I've said something there that you need to be aware of. The key word there is surprise. FX markets move when there's been a surprise. So imagine this scenario. Imagine the central bank was saying to the market for 6 weeks that they're going to raise interest rates by 50 basis points in December's meeting, okay? Would that be a surprise when they raise interest rates? No, they've been communicating it. And so when they communicate it, traders like me would never make a trade when a central bank's been communicating something for days and weeks, because there's nothing new there. The market's been pricing it in, and what you would typically see is a buy the rumor, sell the fact response. So that the central bank would hike interest rates, and then all of a sudden the currency falls. And you might see that and think, gosh, Giles, you told me that when a central bank hikes interest rates, the currency should rise. But yesterday, the central bank hiked interest rates and the currency fell. I don't understand. And the reason that is because markets and professional traders and professional analysts what they're doing is they're looking weeks in advance. So what I'm looking at in a currency is what I'm expecting quite a few weeks in advance, not really what's happening now. I'm looking at what I'm expecting. So when a central bank hikes and cuts or increases interest rates by a surprise, that's when you'll see the reaction. And here's a few trades that I've taken over COVID time on central bank interest rate surprises. So this was prior to COVID, but this was when the Bank of Canada, they increased interest rates by a surprise amount, took markets by surprise. That's a daily chart. And you've got there about 2 weeks solid of Canadian dollar strength after the central bank hiked interest rates in a surprise meeting. Here's another one. The Reserve Bank of New Zealand cut interest rates August 7, 2019. Big surprise. What happened? The New Zealand dollar sold off very, very rapidly against the yen. That was a trade that I took back in 2019. Trades like this for a professional trader are very nice to trade because you're expecting one direction and you can use leverage and you can make those trades really count. Here's one during COVID where the Bank of Canada surprised markets and they cut interest rates by 50 basis points. So that was a surprise. And you can see here that the Canadian dollar Japanese yen pair fell 137 points. The reason I traded it against the yen is because the yen during that time was tending to gain on safe haven flows. So remember, one was strong, the Canadian dollar, one was weak, the Japanese yen. So I'm pairing weakness against strength, and you can see how the chart just moves one way. As a professional trader, that's what I want. I want to see price just move one way, and those kind of environments happen. Here's one with the Federal Reserve during COVID. They surprised markets with a 50 basis points interest rate cut, and I traded gold higher on the dollar weakness, and you can just see there, gold moved up from about 1620 up to about 1700, and I just took profit on that trade after a couple of days. Similarly, the Aussie dollar, when the Reserve Bank of Australia, they cut interest rates, and then there was expectations that they were going to embark upon quantitative easing for Thursday, March 19th. So there was a good example where I could expect the Australian dollar to be sold off into the meeting because of the expectations. And then where you see the candle recover, it's when they did do QE, but only as much as the market was expecting. So it was a good example of buy the rumor, sell the fact. And I was actually asleep overnight. So when I came back to my chart, I just closed out the trade. Okay. So there's a few good examples. Now they're great examples because it is examples when you've got interest rate being cut by a surprise. Now, most of my trading involves looking at shades of gray. Okay, you're looking for hints, and here's an example with the RBNZ. So the Reserve Bank of New Zealand, they are expected to hike interest rates on November the 23rd. Okay, so let me start running through with you how I do my analysis. So here I'm expecting a 75 basis point rate hike on the 23rd of November. The current rate is 3.5%. Here's my short-term interest rate markets, what they're expecting. They're expecting a terminal rate of 5.40%, which is up from a week ago of 5.15%. So what does that tell me? It tells me that the market is getting more aggressive towards hiking interest rates as we move towards the meeting. We then have the RBNZ expected, this is courtesy of Financial Source, these implied interest rate curves, are expected to hike interest rates by 66 basis points. So we work out the probability and we see that there's now a 64% chance of a 75 basis point rate hike. So what does that tell me? It tells me this: if the Reserve Bank of New Zealand only hike by 50 basis points, there is a market pricing that has to adjust, because 64% probability was seen for an interest rate hike of 75 basis points. It didn't happen. So a 50 basis point rate hike would be a disappointment, and I'd expect the New Zealand dollar to fall. And I would look to trade that against the Australian dollar, because a central bank policy against the RBA and the RBNZ is a general good currency pairing. So, okay, so that's what I'll be looking for. So 50 basis point hike would be a surprise, and I'd expect some reasonable upside against the Aussie New Zealand dollar. If I came to the market for the European Open the following day, I would expect an Aussie New Zealand dollar upside bias. Now, if you look, say there was a 100 basis point rate hike, that too would be a surprise, and I'd expect New Zealand dollar strength. And then I'd look to short the Aussie New Zealand dollar pair on that New Zealand dollar strength. So there we go. You can see what my expectations are. Now, these expectations constantly change. Now, I'll just show you how I put an extra layer of analysis to this. Let me just show you. I'll just, right. So here is the data that's come in from the RBNZ, from New Zealand, over the last sort of few weeks. Now, the RBNZ are one of the most hawkish central banks. So since their last interest rate decision, what we've seen is, do you see how the New Zealand inflation rate, do you see how it came in at 7.2%? Can you see that? Okay. So there is 7.2%, and that was above the market's maximum expectations of 6.9. And the quarterly data came in at 2.2%, which is above the market's maximum expectations of 1.8. So what that tells you is that inflation is higher than economists have been projecting for New Zealand. That means the RBNZ will need to be hiking interest rates more aggressively as a result. So that's why you would expected the New Zealand dollar to strengthen that day. So if we go back to our interest rate projections, you'll see, let me just get this, you'll see on the 17th of, so where are we, 38. Do you see around October, the 17th of October, do you see how the implied interest rate moved higher? Because short-term interest rate markers think, higher inflation, the RBNZ are going to have to hike interest rates, so the New Zealand dollar should gain. And now look at this. Then look at the employment data that came out not too long ago at the start of November. Do you see how the unemployment is 3.3%? So that's pretty low. And remember that unemployment has been very low across the world recently. So that's low. It's a slightly disappointing reading, but still very good. We've then got the participation rate, which is higher, 71.7%, above market's maximum expectation. Great. There's a higher participant rate in the labour market. And look at the employment change. It's up 1.3%. So there's even more people entering the New Zealand job market. Now, we know that the RBNZ, they're worried about a wage price spiral. So more labour, low unemployment, you get worries about a wage price spiral, higher wages, higher prices, higher wages, higher prices, all inflationary. So what does it mean? It means the RBNZ are going to be more likely to be hiking interest rates. So that's why you can see from the start of November and the start of October on this interest rate expectations implied basis point chart, you can see that they're rising after both those events. And that's how I reach my trading decisions like that. Yeah, so Atif says, can we say if there's no surprise, then the currency is priced in already? Yes, you can, but you can see there's a grey area, Atif, here, because say that was say it was a 50% chance of a 50 basis point hike and a 50% chance of a 75 basis point rate hike. There's an element of surprise either way. But generally speaking, if there's no surprise, if it's what the short-term interest rate markets are expecting, and it's what economists are expecting, then there's no surprise. Sometimes these are different, Atef. So what you'll get is sometimes you'll get economists are expecting an interest rate hike, but maybe the short-term interest rate markets aren't. So you also have to factor that in when you're trading. And the more people that are surprised, the bigger the result. The less people that are surprised, the less the result. That's the way of doing it. Yeah, Latif, shouldn't central banks be careful from raising interest rates too much in order to avoid a recession? That's exactly right. And that's what many people I read a survey by Bloomberg at the end of October. And most economists are worried that the Federal Reserve is being too aggressive in hiking interest rates and is going to unnecessarily create a hard landing. In other words, a deeper recession. So central banks have to balance that, Lotfi. They have to think, well, we have to hike interest rates, but if we do it too hard or too quickly, then we risk bringing about too bad a recession. And it's very hard for a central bank because when they hike interest rates today, it might not be felt until 6 months in the future. So it's very difficult. That's the lag effect. And if you read the last Federal Reserve meeting, you will see that the Federal Reserve, when they issued the statement, they said, we will be conscious of the lagging effect of monetary policy. So what they're saying is we're just going to be careful. So is there not a big chance it will turn into a deflationary environment since inflation is a lagging indicator, as you just mentioned? Not at the moment, Simon. There isn't really risk of deflation. And we did have a deflationary environment for about a decade, and Japan had it for like maybe 12, 13 years and couldn't do anything to get rid of it. But now we're very clearly in an inflationary environment, and the biggest risk is stagflation, when you get high inflation and low growth. So that's the major risk that we're at the moment. Atofa, which software or website you're using? One of my other roles is I work as an analyst for Financial Source, and I'm using short-term interest rate markets information from the Financial Source web software. Okay, good, right, excellent. The other tool they use is price control. This is generally not very effective. And central banks don't like to use it. You'll probably know the famous example with the SNB, when the Swiss National Bank said that they would be pegging the Euro-Swiss franc pair to 1.20. They managed it for about 3 or 4 years, and then they gave up defending the peg very famously in January the 15th, 2015. The Swiss franc moved by about 40% in about 10 minutes. Hedge funds went bankrupt. Loads of retail traders went bankrupt. Defending a currency level is basically always unsuccessful. The RBNZ have tried it. They failed. The Swiss National Bank tried it, failed spectacularly here. The People's Bank of China, they were mooting about trying it. They decided not to try it, and they would have failed anyway spectacularly. And you may know one central bank that's kind of toying around it with the edges, which is the Bank of Japan. Now, they haven't come out and said, because they're obviously sensible people, that they're defending a level. But they have been intervening a couple of times now around this 145 level, okay? Generally speaking, you can't fight market forces forever. You can maybe push things a little bit, you can maybe hold back the tide, but eventually you have to capitulate to it. The Bank of Japan, they tried to defend the yen back in the 80s. In the end, they were successful because of some other market dynamic that took over. So the best hope for the Bank of Japan is that the Federal Reserve starts slowing their path of interest rates. But this is another tool that central banks will use. Now, from an economic big picture point of view, this is a failure, right? But from a trading point of view, there can be good opportunities to be had, because you can maybe take 50, 100, 150 points out of the market. So you have to balance the big picture and the short-term opportunity constantly when you're trading central bank policy. And I surprised one of my friends the other day, because one of my friends doesn't work in finance, we were talking about you know, the FTSE and some opportunities that were there. And then he said to me, Giles, you know, what do you think is going to happen in 6 months' time to 12 months' time? And he was with the finances in the UK, and he was waiting for me to give some profound, wise answer. And all I said to him is, I've got to be honest, I really don't care, because it doesn't make any difference to me from a trading point of view. All I'm looking for in my job is short-term moves from what's expected. And that's how I go about making my trading decisions. I'm looking at short-term moves. Now, if I was looking at more philosophically, of course I would care. And of course, there's a different part of me that thinks what will happen. But as a professional, I know that projecting what's going to happen 6 months in advance in the financial markets is virtually impossible. And if I made decisions based on what I thought was going to be happening in 6 months' time, you know, I wouldn't be able to be a successful trader. I have to make decisions every day, and every day I make decisions. The next day, I think, does that still hold true today? Okay, literally every single day. If I make a decision on one day, the next day I'm thinking, is that still true? Language. Remember what I said about language? So let's look at the Federal Reserve last week, an example of the language they used. I've highlighted this here. This was in the press conference. Now, I was trading this live with a group of traders. And when we had the rate statement, and this comes back to your question, Atef, the statement said, the Fed said, we're going to be taking into account the lagging indicators of monetary policy. Now that's more dovish, because that's more cautious. So that's what the Fed did in the statement. But then there's the press conference. So whenever you're trading central bank statements, you might make a mistake and think it's one event. No, it's not one event, it's two. And in the case of the ECB, it's 3 events. 1, the statement. 2, the press conference. Central bankers are clever, and they know they're playing cat and mouse with the market. If they misstep or make a wrong kind of decision, they know that they're going to send the market racing. And if they get that wrong, they can create trouble just by the words they say. So what they do is they have the statement, and then they see how the market reacts. Have you ever wondered, why is the press conference 45 minutes, half an hour after the statement? Is because they want to see what's happening. Now, in my opinion, Jerome Powell was very, very clever in the way he announced the market. And I haven't got time to explain the context. But he basically gave something more dovish to the markets and allowed people to go long. And then in the press conference, this is what he said. He said, if you look at the last sentence, it says, even so, we still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. So what's he saying? Higher interest rates. What does that mean? Dollar strength. Okay. So he's saying we're going to be going higher. And here you can see the dollar index. Powell says terminal rates will now be higher. See the way the dollar sold off and then shot higher. That was because of the way Powell played it. You had the rate statement, and then that's the 1 hour chart. And then you had the reaction to the press conference. And again, look at the sentence that isn't highlighted immediately after the one that I've highlighted. It says, our decisions will depend on what? The totality of incoming data and their implications for the outlook for economic activity and inflation. So there's the central bank telling us what they are looking at and how they will use that information for their trading decisions. And that's how we go about making our trading decisions. I'm running a little bit short of time, and I've got a CNBC Arabia interview at 2:15, so I'm going to try and close this up in the next sort of 5 minutes, but I do want to allow us time for questions at the end. Quantitative easing, I'm going to deal with very briefly. It's basically the way that a country injects money directly into the economy, and it basically weakens a currency. You can see the Bank of Japan have had a huge quantitative easing program for years and years and years, and it's been keeping the yen weak pretty much all year, okay? When the Bank of Japan famously started their quantitative easing program in 2013, you can see the dollar yen moved from about 80 up to about 128. And they just weakened their currency against the dollar, huge move. Now, those of you who observed say, well, what about the emergency quantitative easing by the Bank of England a few weeks ago? Well, I thought I'd cover this because we're here. Now, when the Bank of England moved into the UK gilt market, it wasn't that they were conducting quantitative easing. They were trying to stabilize the bond market. Sorry, my cat's making an entrance. The bond market, when yields rise in bonds generally because investors are expecting higher interest rates. But there's another time when yields in bonds rise, and that's in signs of distress. So UK gilt markets were very distressed. So bonds were selling off, not because they're expecting higher interest rates, but because of distress. And so they have to offer a higher and higher yield to encourage investors to lend money to the UK government. So the Bank of England subdued the bond market, and that allowed the pound to gain. So that was a trade that I was taking at the time and explaining to the traders who I was like, look, this is not something to sell the pound, this is something to buy the pound because it's an abnormal interaction into the bond market. And yeah, we've looked at the RBNZ. That was just a duplication of what we covered. Okay, great. So that was a lightning introduction to making FX decisions on trading central bank policy. I'm going to get to your questions now, and I'm going to deal with them one at a time. Simon, do you at all use technical indicators trading FX, or do you mostly rely on the fundamentals, or does it depend on time frame? So Simon, I combine two things. I use fundamental analysis to pick my direction, and I use technical analysis to execute my trades. And I'll usually use pivot points when I'm trading FX markets. And if I'm trading like S&P 500, I'll use things like depth of market and delta volume and volume weighted averages, things like that. Atef. Yeah, intraday technical indicators, swing trading fundamentals, and sometimes a mix of both. Is that what you do, Atef? I'm with you. Yeah, fundamental swing trading makes sense. But what you have to be aware of, and I'll give you a warning here, Atef, and I'll show you something here, right? There is a danger if you swing trade using fundamentals. Let me give you a little warning without using technicals. And this will save you a lot of heartache, right? Now, this is a basket of the New Zealand dollar that I've got here, right? Now, if you go back on this chart, I'm just going to 2021 November, right? You can see, yeah. So 2021 November. Now, the New Zealand dollar there became one of the most hawkish central banks of all the major banks in the world. The New Zealand dollar was the most hawkish one. And yet it fell after that very hawkish RBNZ meeting. It fell, on this basket, nearly halved its value. Eventually it moved back up in line with what the fundamentals were expecting. But if you just traded that only on a fundamental basis, Atef, you could have been hundreds and hundreds of points underwater in drawdown. So I always combine technicals to allow myself, where am I going to get out? Where am I wrong? Because I can always re-enter. So say I thought, okay, I've got a bias to go long the New Zealand dollar, which I did. Okay, you've got a bias to go long. Maybe you're expecting 114 on the basket. It moves below 98. You think, well, I'll just take my loss. Well, then you can always re-enter back down here, can't you? At 80 or 70, 72, and just if you only use your fundamentals, sometimes the fundamentals take a while to kick in. And that's like 3 or 4 months that it took to kick in for the New Zealand dollar. So you have to be aware there's a risk of ignoring technicals. Thank you very much. Noted. Good. I've saved you a bit of heartache there. Simon, as an FX guy, do you trade any cryptocurrencies or you leave your fingers off it for some reasons? No, I'll be very happy to trade crypto. I'm happy to trade lots of different markets. And I see no reason not to trade them. As long as I'm managing and defining my risk carefully, I'm happy to do that. Omar, what policy should the central banks approach regarding avoiding any upcoming financial crisis? So if they hike interest rates too aggressively, then they risk making the recession much deeper. And the problem, Omar, is that if interest rates are too high, then unemployment will get very high. And if unemployment gets very high, you'll have civil unrest. And if you have civil unrest, you might then have political upheaval. And if we have lots of countries who have lots of high unemployment, lots of civil unrest, you then have an appeal to more nationalistic policies. And that's more like to set nations against each other. And say, for instance, it could inflame the Russia-Ukraine crisis that's currently going on. So central banks need to keep hiking interest rates as they're doing, but they need to try to make sure they avoid a hard landing on the one hand, but they've also got to avoid not doing enough. If they're too slow and they don't do enough hiking of interest rates, then inflation risks getting out of control. And if you go back in the UK in the 80s, interest rates had to rise to about 16%. So central banks have to do enough for the economy to feel pain, but not too much that it results in civil unrest, and not too little that it just makes the inflation problem worse. That's in my humble opinion, Omar. And, I don't envy central bankers and politicians. They have a very difficult job. And there is a lot of, in my industry, there's a lot of cynicism about central banks and governments. But actually, the truth is they are just trying to make quite difficult decisions. Many times there isn't an obvious, easy answer. Many times it's quite a difficult decision that they have to make. Thank you, Omar. A good question. Yeah, Aldo, could you please share a little bit more depth on how you estimate the probability of the most likely interest rate decision and what platform tools can be used for this estimation? So I use the financial source and we look at short-term interest rate probability, and we have a spreadsheet that updates that chart based on what the probabilities are expected from the short-term interest rate markets. Yeah. Okay. Thank you all very much. I hope that's been helpful. I hope that hasn't been too simple for you, and I hope that's been about right. I hope you've learned a few things during this webinar.
Thank you very much, Giles. So it was very insightful, very interesting. And I hope we can invite you again.
Yeah, lovely. And if you said to your students, what other topic would they like me to do that would maybe follow on from this, let's talk by email. Maybe they can just write some suggested topics in the chat box, so I can have an idea as well, so we can discuss later with you. Yeah. What? So if you have, sorry, if you have any idea, anything you want to talk about, any suggestion, please write to the chat box so we can discuss with Giles and we can organize another seminar. I mean, depth of market's quite interesting, and footprint trading on the S&P 500, more practical examples, yeah. Giles, can you open your first slide to have one picture to share in our social media? Oh yeah. What did you? Can I share?
Your first slide, maybe, just to
yeah.
see the topic. Okay. Thank you very much.
Oh, look, this is a live trading session. I would be happy to do that. Where to enter and exit. One thing that I could do is I could always do like a 1 week look ahead and show you how I go about trading economic data.
Okay. Maybe we can organize early December if you will have time before their final exams.
Yeah. Oh,
Okay.
depth of market and liquidity manipulations. Yeah, be very happy to do that.
Okay.
I'll let you talk amongst yourselves and get in touch. We'll try and arrange something.
Okay. Okay. Thank you. Thank you very much. Enjoy the rest of the day.
Thank you very much. Goodbye, everyone.